The typical portfolio advice you receive from legacy financial institutions, the classic 60-40 split, the guaranteed growth of the major market indexes, the steady dividend reinvestment, is frankly obsolete. It is advice engineered for an era of monetary stability that has utterly collapsed. If you are operating your financial future based on the belief that central banks can successfully manage away trillions in debt without catastrophic currency devaluation, you are standing directly in the path of a coming financial freight train. Forget the short-term noise. Forget the quarterly earnings reports designed to distract you. We are not talking about trading strategies. We are discussing foundational shifts in global capital allocation driven by systemic insolvency and unavoidable resource scarcity. We are talking about legacy wealth preservation and massive asymmetric upside over a specific medium-term time horizon. The question is, where does the truly smart, patient, and knowledgeable capital migrate when the paper assets of the world begin to suffer terminal decline? This is precisely the thesis that the legendary resource investor and mining magnate Sprott has refined over decades. A man who built his fortune by seeing the inevitable before anyone else, who understood the inherent fraudulence of perpetually expanding fiat currency systems, is laying out his playbook for the next 7 years. Why 7 years? This timeline is crucial, and it's tied directly to the necessary investment cycle required to bring substantial new supply online, a cycle that, currently, is profoundly broken. Sprott's framework is not about guessing when the Federal Reserve will pivot or what the next employment report will show. It is an investment philosophy built upon irrefutable macro realities. The first reality is the debt pile. Global sovereign debt is not just high. It is geometrically impossible to repay in real terms. Governments worldwide are addicted to spending, running trillion-dollar deficits year after year, guaranteeing that the only viable path forward is to inflate the currency away, to print more dollars until the debt burden is effectively diluted to insignificance. This is a covert tax on savings, and it makes cash, bonds, and anything priced exclusively in fiat currency a destructive asset class. The second reality is scarcity. The world needs materials, massive quantities of them, to facilitate the energy transition, to rebuild decaying infrastructure, and increasingly for geopolitical remilitarization. Yet, the entire resource sector, particularly the mining sector, has suffered over a decade of severe underinvestment. Capital allocation has favored technology and speculation, not the dirty, difficult, and highly regulated business of pulling essential materials out of the ground. This creates the ultimate conflict: unprecedented monetary inflation meeting a guaranteed supply contraction. The only possible resolution for this economic tension is an explosive repricing of hard assets. So, if you are looking to position your portfolio for maximum leverage against inevitable currency devaluation and profound supply shocks, you need to understand the mechanics of the market Sprott is targeting. What specific macro-tectonic shift is he betting on? Why does he believe the 7-year window is the optimal period for accumulation and realization? And crucially, what is the single most leveraged sector that he believes will offer 10-to-1 or even 20-to-1 returns, while the broader market struggles just to keep up with inflation? The answer, as always when looking at foundational wealth, circles back to the monetary metals, but not in the way most people think. We are not talking about buying generic gold exchange-traded funds and hoping for a 5% annual return. Sprott is focused on maximizing the operational leverage inherent in the mining ecosystem itself. Think about the dynamics here for a moment. To truly grasp the gravity of the impending supply crunch, you must understand the current state of the mining industry. Building a large-scale mine today is a Herculean task. It takes years of political negotiation, multi-year permitting processes that often fail, massive upfront capital expenditures, and the ever-present opposition from stringent environmental and community groups. Even after clearing those hurdles, ore grades, the concentration of the desired metal within the rock, are consistently declining globally. This means miners have to move more dirt, use more energy, and spend more money to extract the same amount of metal they did 20 years ago. The average time lag from discovery to production for a major metal deposit is conservatively estimated at 12 to 15 years. What this means for investors is that even if the price of a commodity doubled tomorrow, generating a frenzy of exploration and investment. The market cannot physically bring substantial new supply online for well over a decade. The existing operating mines are the bottleneck, and they become the highly leveraged beneficiaries of any significant price move. This supply rigidity is the cornerstone of Sprott's 7-year plan. He anticipates that within this time frame, the monetary inflation driven by global debt will accelerate past the point of central bank control. This acceleration will inevitably force a material repricing of gold and silver to reflect the true devaluation of the underlying fiat currency. When gold and silver prices move significantly, let's say gold goes from $2,000 to $5,000 per ounce, the impact on the profit margins of miners is explosive. If a mine can extract gold at a cost of $1,500 per ounce, and the gold price is $2,000, they make $500 profit per ounce. If the price jumps to $5,000, their cost remains relatively stable at $1,500, but their profit jumps to $3,500 per ounce. That is a 7-fold increase in profit for only a 2.5-fold increase in the gold price. This phenomenon, known as operational leverage, is why Sprott is focused on the equities, not just the physical metal itself. If you are finding this deep dive into the underlying mechanics of commodity cycles valuable, please take a moment to hit that like button and subscribe to the channel. Your engagement ensures we can continue to deliver these high-level investment playbooks from the titans of the industry. This is not the time to be complacent. This is the time to be surgical with your capital. Sprott views the current prices in the precious metals space as deeply undervalued relative to the fundamental monetary forces at play. He believes the massive investment flow necessary to truly combat the chronic supply shortage has not even begun. The market is still operating under the illusion that debt can be serviced and the status quo will hold. But the cracks are becoming canyons. The first major revelation in Sprott's strategy for the next 7 years is his foundational asset class commitment. He is betting overwhelmingly on precious metals and the related mining equities. But this is where the specificity begins and the generalized advice ends. He is not interested in every mining stock. He is focused on identifying those specific companies that offer the highest degree of operational leverage and the most constrained supply profile. He looks for management teams that have prudently managed their debt, possess high-quality assets in geopolitically safe jurisdictions, and, crucially, are significantly undervalued based on a conservative projection of future metal prices. This is the difference between simply owning the resource and owning the machine that efficiently produces the resource when prices explode. We have established the conflict, fiat debt versus physical scarcity. We have established the timeline, 7 years, dictated by mining development lead times, and we have established the sector, highly leveraged precious metals equities. However, the key to unlocking the exceptional returns that Sprott forecasts lies in the highly detailed selection criteria and the crucial difference he sees between the two major monetary metals, gold and silver. While gold provides the foundational store of value and stability, one specific metal offers geometric returns due to its dual nature as both a monetary hedge and a critical industrial commodity. To fully understand the 4 specific criteria Sprott uses to select his top 10 stocks, and to hear exactly why he favors silver over gold in the short term, you must join us for Part 2. Make sure your notification bell is turned on so you don't miss that crucial follow-up and the ultimate unveiling of the actionable components of his multi-year investment plan. Do not let this opportunity pass you by. Join us in the next segment for the hard specifics. It is fundamentally critical to understand that the defensive stance against monetary disaster is only half the battle. Eric Sprott, the man who has spent decades navigating the deepest waters of the commodity markets, is not merely interested in preserving capital. He is interested in multiplying it exponentially during the coming crisis, and that requires moving beyond simple physical bullion. We have established the why, the inevitable sovereign debt crisis, coupled with unprecedented currency debasement. Now we drill down into the where and the how for the next 7 years, because the timeline is just as crucial as the asset class itself. Sprott's strategy for this period hinges entirely on the concept of leverage. When you anticipate a 100% move in the price of physical gold, You shouldn't be satisfied with merely receiving 100% return. You should be positioning yourself to capture 300, 500, or even 1,000% returns. This necessitates moving into the equities of the companies that are actively pulling those precious metals out of the ground. But not just any companies. The conflict we face in the precious metal space is the massive disconnect between the paper market and the physical market. The derivatives and the futures contracts have artificially suppressed the price of gold and especially silver, creating a false equilibrium. This is the tension that Sprott exploits. He is convinced with absolute certainty that this suppression is reaching its breaking point. Once the physical shortages in vaults and the industrial demand for silver, the world's most crucial industrial metal, truly collide with this artificial pricing mechanism, the price explosion will be volcanic. To capitalize on this, we must look at silver first. While gold holds its value and protects purchasing power, silver is the instrument of extraordinary wealth creation in this cycle. Why? Because the supply-demand picture is fundamentally broken. Silver is consumed. It is used in solar panels, electronics, and rapidly expanding green energy infrastructure. And crucially, it is often treated as a byproduct of base metal mining, meaning its supply is inelastic to its own price signals. We are draining inventories year after year, yet the price languishes, held down by enormous leveraged short positions in the paper exchanges. Sprott's investments over the next 7 years are heavily weighted toward closing this gap. He maintains a massive position in physical trusts, specifically those that offer segregated, auditable physical metal like the PSLV for silver and FWIS for gold, ensuring his capital is safely outside the banking and custodial systems that might fail or freeze during a true crisis. This is the foundation, the defensive pillar. But the real leverage, the strategic allocation for the 7-year multiplication phase, lies entirely within the junior mining space. This is a highly specialized sector, fraught with risk for the uninformed, which is why it offers such potential rewards for those with Sprott's geological and financial expertise. We are not talking about massive established producers like Barrick or Newmont. Those are essentially leveraged bets on the gold price that carry the heavy burden of massive overhead, labor issues, political risk across dozens of jurisdictions, and high stripping ratios. Sprott is focused on the exploration and development companies. These are the small-cap companies that are sitting on huge, proven resources in the ground, but have not yet constructed the mines. Think about the timeline. If a company today proves up a 20 million-ounce gold deposit, it will take 3 to 5 years to secure financing, finalize permits, and move into actual construction. By year 7, they are transitioning from an exploration target, valued at pennies on the dollar, to a mid-tier producer with actual cash flow. If, during that exact 7-year window, the price of gold doubles or triples due to monetary collapse, the stock price of that junior miner doesn't just double, it can multiply by 10 or 20 times because the market is simultaneously re-rating the metal price and re-rating the company from a speculative asset to a producing asset. This double leverage is the key to the multi-bagger returns Sprott seeks. This brings us to the most crucial pattern interrupt in his strategy: jurisdiction. Sprott is ruthlessly focused on Tier 1 jurisdictions, places like Canada, Australia, and certain stable parts of the United States. Why? Because when metal prices spike, resource nationalism explodes. Governments get greedy, contracts are ripped up, and assets are seized. By focusing only on politically stable areas, he de-risks the major component of junior mining investment. This specificity is non-negotiable, and if you're finding this deep, tactical insight valuable, please take a moment right now and hit that like button. We rely on your engagement to keep delivering this kind of essential strategic breakdown. Now let's drill down into the climax of the strategy, the specific financial instrument he favors above all others for mitigating risk while maximizing future cash flow: royalty and streaming companies. This is the ultimate expression of Eric Sprott's maturity as an investor. Royalty companies don't dig holes, manage labor, or pay for diesel. They provide upfront capital to the miners in exchange for a perpetual percentage of the revenue, a royalty, or a right to buy future metal production at a fixed, low price, a stream. Why is this perfect for the next 7 years? 1. Zero operating risk. If the mine has flooding problems, labor strikes, or cost overruns, the royalty company doesn't care. They still get their percentage of whatever metal comes out. 2. Infinite cost. Control. Their costs are fixed. If inflation runs rampant and production costs for the miners double, the royalty company's cost to acquire the metal, often fixed at 20% of spot price, remains the same. Their margins widen dramatically as metal prices rise and mining inflation escalates. 3. Diversification. A single royalty company might hold royalties on 40 or 50 different mines worldwide, spreading risk across multiple deposits and jurisdictions. Sprott sees royalty companies as the single best way to participate in the exponential growth of juniors and the price increase of metal, while mitigating the single largest risk factor, operational execution. His major allocations are disproportionately weighted toward these royalty and streaming businesses, specifically those that hold streams on future production from promising junior miners that will only come online toward years 5, 6, or 7 of this cycle. This 7-year time frame is not arbitrary. It is the calculated period required for the monetary consequences of the last 15 years of quantitative easing to fully mature into a crisis, and simultaneously, the time required for strategic junior mining assets to transition into high-value producers. In conclusion, the allocation is clear. A foundation of physical bullion and audited trusts for safety. A substantial allocation to ruthlessly vetted Tier 1 junior exploration companies for maximum leverage. And finally, the strategic overweighting of royalty and streaming companies as the ultimate vehicle to capture generational wealth from the rising tide of metal prices without the crippling operational risks inherent to mining. The open loops are now closed. The conflict, the artificial price suppression, will be resolved by the relentless arithmetic of supply and demand and the collapse of currency confidence. The specific plays are in place. This is where Eric Sprott is placing billions of dollars, positioning himself not just to survive the coming monetary restructuring, but to thrive beyond imagination. Don't let this information simply wash over you. The difference between those who merely survive the currency crisis and those who generate true, lasting generational wealth lies in acting on these highly specific tactical allocations. If you want us to dive even deeper into the specific tickers and companies within the junior mining and royalty space that Sprott has been accumulating, make sure you smash that subscribe button right now and turn on the notification bell. Share this video with anyone you know who is still holding a majority of their wealth in fiat currency, because time is rapidly running out. This 7-year window starts now, and hesitation will be the most costly mistake you can make.